This is the fourth part of Warren Buffett's top quotes to inspire your investment goals. If you want to listen previous part, please visit the channel playlist. Okay, now continue our journey to reach the goals. 14. Risk comes from not knowing what you are doing. A little bit of research can reduce a lot of risk. Buffett is ever the pedantic investment professor, and in this quote he reminds us that we should study, study, study. However, this advice can be often forgotten, especially after an investor has seen some success. A positive feedback loop can be misleading and indeed dangerous for investors. Instead, as any good teacher prescribes, Buffett instructs that we do our homework. Research the rules of investing, study holdings before deciding why to invest in ETFs, and learn the lessons of historical data. All of these are important factors that will improve your understanding of the market and reduce your risk when participating in it. 15. It is a terrible mistake for investors with long-term horizons, among them pension funds, college endowments, and savings-minded individuals, to measure their investment risk by their portfolio's ratio of bonds to stocks. Though portfolio diversification is crucial to minimizing risk, it is possible to overdo it. While some bonds might be good to diversify a portfolio, the longer the time horizon, the less the need for them. For example, an investor with a 12-year horizon may not require a portfolio with 50% bonds. In this case, there is enough time to ride the price volatility of the stock market and make good returns. To put this into perspective, the S&P 500 returned an average of 11.97% per year between 2010 and the end of 2022. In that same period, the highest yield on the U.S. Treasury bond was 3.829%. When the time horizon shortens significantly, but in the meantime, investors with long-term horizons should continue to prioritize maximizing returns in a diversified portfolio of stocks. Some bonds might not be bad, but, at this stage, it is better if their allocation is on the low side. 16. Remember that the stock market is a manic depressive. Following stock market news can be depressing. Because the stock market is volatile, stock prices move up and down. And investors who don't have the emotional intelligence to weather that volatility might end up making poor decisions. Investors must understand that short-term price movements, especially declines, are reflections of investors' speculation rather than the underlying value of the stock itself. Understanding this will help investors stop considering every fall in price as a significant event requiring a response. Instead, investors should focus on whether a company is keeping its comparative advantage and if the management team is still working by the principles that made the company a good one. It's only changes in these more fundamental factors that necessitate a response from the investor. Everything else is just noise. 17. Do not take yearly results too seriously. Instead, focus on 4 or 5-year averages. In the above point, we said that short-term price movements are not that significant because they do not reflect underlying value. In fact, for Buffett, even 1-year results belong to the short term. That is, not even the 1-year rise or fall in the price of a stock should be taken so seriously as to demand a decision from the investor. Significant price changes that reflect underlying value begins, for Buffett, when considering average movements over 4 or 5 years. As he said somewhere else, time is the friend of the wonderful company, the enemy of the mediocre. Wonderful companies grow in the long run, because then their prices reflect their underlying value rather than the short-term emotions of investors. In essence, don't judge a company by its 1-year return. Take a longer view. 18. Never invest in a business you cannot understand. What Buffett says here about businesses' individual stocks is also true of every other investment asset. A primary reason why people lose money when they invest is that they invest in assets or businesses they don't understand. Most times, they do it based on the advice of a family, friend, or a complete stranger, who has supposedly made millions from such assets or business. Sometimes, they do so because the particular asset or business is trendy and FOMO, fear of missing out, what Buffett calls greed, compels them to get in on the ride. Blind faith in others that totally discounts the need to do personal research, as known as due diligence, is the bane of countless investors. Before buying any asset, stock, bond, right, ETF, cryptocurrency, etc., you should seek to understand how that asset works. Most importantly, you have to look beyond the return that they are promising and consider the risk as well. People who promote trendy investment assets focus exclusively on the returns as a way to appeal to your greed. Your first task is to ignore the hype and try to understand the fundamentals of such an asset. Only when you have a basic understanding of the asset, its returns and risks, should you attempt to invest in it. Does this mean that you need to get a master's in finance? Far from it. 19. The most important investment you can make is in yourself. There are two things you should constantly invest in: your ability to make money and your ability to make money work for you. Whatever you do, become better at it so you can command more value and increase your income. But remember that while you can only work for a set amount of hours a day, and for a certain number of years, money, because it is intangible, can work 24/7 forever. 20. Never depend on a single income. Make an investment to create a second source. Here you have the pillar for why investment is so important. In life, we should never rely on a single source of income. Investing opens up a proven avenue to generating that all-important second income stream. In this quote, Buffett also alludes to the importance of basic diversification. By establishing more than one income source, we essentially begin to diversify our own revenue streams. Thanks for watching this quotes. Request you to like, share and subscribe your own channel to grow like your money.